Hey guys, today we're going to talk about cash flow and why it shouldn't be the only and probably not even the top thing you should consider when buying a rental property. Like many, I started my real estate investment journey by reading Rich Dad, Poor Dad, where I learned about the cash flow quadrant. When you think about it, the idea of cash flow makes perfect sense. If I could create more cash flow than my monthly expenses, then theoretically I would be financial free and not have to work a job anymore or do anything I really didn't like to earn a paycheck for the rest of my life. And I think a lot of new investors come to that conclusion as well, rightfully so. While I think cash flow is important, it has its purpose, I don't think it's the top thing you should even consider when you're buying rental property. And too many beginning investors only think about cash flow when they start their real estate investing journey. Real quick, I'm Andrew McGuire. I'm an investment-focused real estate agent right here in the Phoenix Metro in Arizona. If you're thinking about investing in, moving to, or buying a second home in the Phoenix area and need just a little help along the way, my contact info is in the description below, along with my ultimate investment guide for the Phoenix market right here in 2023. I see this a lot with friends and others on platforms like the popular networking for real estate investor group, BiggerPocket. A lot of these investors want to invest in markets that are really cheap, where they see high percentage of cash on cash return, 8%, 10%, even 15% and above, flaunted as being a high cash flow market. And I have friends and investors who bought in Midwest states that are cheaper to get into, like a friend who recently just bought a property in Iowa for a purchase price of $80,000. And that property rents for $1,100 a month. This achieves that 1% rule easily with a purchase price of $80,000 and monthly rents of $1,100. And theoretically, if you're going off the 1% rule, that deal would be a great deal, yielding over 1% of the monthly rents of the total purchase price. The problem with buying in cheaper markets that have higher cash flow is that when you really start to look at the true cash flow numbers, they tell a much different story. And after all the headaches, maintenance, operations costs, you name it, of buying those cheaper rentals, a lot of time they don't end up yielding a lot. And then after, when you go to sell the property that you bought 10 years earlier for $80K, you realize that you didn't get much appreciation. It didn't really go much up in value over those 10 years that you own the property. And that's exactly why I don't personally invest in these markets for now. A couple of reasons I don't like investing in cheap markets. A lot of the times when you have properties that have lower rent values, you end up having more headaches. I'm not going to talk about getting into rich and poor and what comes along with that. But what I've noticed with my own property is that the lower the rent is, there seems to be more maintenance, there seems to be more headaches, and just overall problems with the property that end up being pretty costly expenses. Another reason that I don't like cheaper rentals is that one big expense for the year can totally wipe out any cash flow. Let's take this property that's renting for $1,100 a month. At the end of the year, you're over $13,000 revenue. You're only keeping a portion of that as far as cash flow. Let's call it they had a great year and they returned 25%, or roughly about $2,800. Now, your furnace goes out, and a furnace to replace that along with installation might cost you that full $2,800. And that's just a small repair. We're not even getting into bigger ticket items like the roof or sewer line or electric yet. Now, even on expensive appreciation markets with properties, you're going to have some expenses every year. But typically when you have a higher rent rate, you can absorb more of those more costly expenses. And I also don't mind making repairs and putting improvements into properties where you actually increase the value of the property. I can't say in some of these cheaper markets, when you buy an $80,000 rental property and you improve the property with maybe a new kitchen or bathroom, typically the price of the property doesn't go up. It's going to stay roughly around that same price range of $80,000 or so that you bought it at. And the biggest reason I don't like buying in cheaper markets is because of appreciation. They don't typically appreciate as much, and that's the reason why they're cheaper in the first place. And that's the trade-off. Typically, when you invest in higher cash flow markets, you're sacrificing on appreciation. Now, you can find some markets that have a little bit of both, but it's really rare to have the high cash flow markets also appreciating as well. If I bought in one of these cheaper markets today, say at that $80,000, in 10 years, it's really not going to be much higher than $80,000. You're probably going to be anywhere from 100 to 120K. We don't know for sure, but typically it's cheaper because of the market it's in, the demand there and the supply, and it's not going to go up that much unless something happened drastically, like with an industry or jobs or a different population migration. But they're usually going to be about the same cost as you purchase them for when you buy in these cheaper markets. Now let's talk about what I do like, and that's high appreciation markets. If you buy properties in these markets, it's like several on the West Coast, including Phoenix, they're typically going to appreciate at a higher rate because there's less supply than there is demand, and there's a lot of people moving to these areas. And these properties that appreciate at a higher rate give you the best chance to build your net wealth. Let's look at the period of what happened in the Phoenix market from the years of 2019 to 2023. If you purchased a home for roughly $300,000 in 2019, if you held on to that property for a just 4-year period, that property nearly doubled in value and is probably somewhere between $500,000 and $600,000 today. That's going to yield you about a net worth increase of $250,000 just by owning one house over a 4-year period. Let's think about if you had 5 houses and each of those went up $250,000. Your net worth would have gone up by $1.25 million in 4 years. And chances are, if you're like most people, that's going to be a higher payday by that going up, a higher increase to your net worth than it would actually to have worked your job for those 4 years and saved every single penny in a savings account. Now, I know it's not realistic. We had an extremely crazy high appreciation, high demand market from 2019 to 2023. But chances are, if you look at migration paths and people moving to a different area, that I could expect a lot of the markets on the West Coast, here in Phoenix as well, to continue appreciation for the next 10, 20, 30 years. Especially with how much money our government's printing, you could see inflation continuing, and real estate is actually a great hedge against inflation. Prices go up as there's more money in the market. That's actually going to push real estate prices even higher, continue to increase. So with what's going on, it seems like we're going to continue to see that. And I would expect most markets, especially the high appreciation markets, to continue to rise over the next 10 years. Should we expect prices to double again here in the Phoenix area in the next 10 years? I think they probably will. Again, we don't know for sure, but from what I've seen, we're going to continue to have a high demand and a lower supply that meets demand. And I would expect prices to double again. Who knows? It could be 5 years. It could be 20 years. We don't know, but I'm pretty sure if you hold on to real estate for the long run, you will have an asset going up and even doubling in price. Now, let's look at the average home here in the Phoenix market. If the property's purchased for a price of $550K, I know just from experience that you can probably expect a rental rate of $2,500 to $3,000 a month renting traditionally for that property. And that's nowhere even near that 1% rule. And your chances of cash flowing on a property like that are pretty unlikely right now. However, I personally would still buy this property that you're trying to get to at least break even over a property that's highly cash flowing in one of these other cheaper markets. The example we used earlier, the Iowa property for $80K, cash flows about $200 to $300 a month. And then the property that we bought in Phoenix for $550K is probably going to go up to a value of about $1 million in the next 10 years. Could I have gotten that cash flow from the other property to generate more wealth for me than my property going up from $550K to $1 million? $450K would be nice, right? I don't think the property in the cheaper market, between its appreciation and its monthly cash flow, will ever get you even close to the property in the higher appreciation market. And then as a bonus, you're probably going to eventually pay that property off, or perhaps refinance another property or sell another property that you can pay off that higher price property. And then you will have great cash flow because typically rental rates go up at a higher pace as well. So when you bought that property, let's say it rented for $2,700, 15 years down the road, you pay off that property and now rents are at $4,000 a month. Now you do have a great cash flow in this higher appreciation market. My philosophy on buying rental properties is this right now, as of today, that if you're still working and making a good income, you don't need every single dollar of cash flow. It's in your best interest to buy the property that's going to help you more easily build wealth, another asset on your balance sheet that's going to go up in value over time. I don't need the cash flow to be financially independent today while I'm still working. So to have those assets that go up and build that higher net worth are of more value to me because, again, I'm in it for the long term. I'm not trying to retire, be financially free tomorrow. I'm still working. And again, these properties are going to have a great cash flow with time. And I'm definitely not suggesting that you buy properties that lose money, everybody. Nobody wants a bleeder. And if we ever get in a conversation, we'll talk about how to avoid that. Find properties that have a decent debt service coverage ratio where you can always rest at night knowing that your mortgage is going to be paid by your tenant. You can achieve this in even high appreciation markets by finding properties with certain characteristics that let them cash flow better, things like additional rooms, casitas, no HOAs, where you can rent as Airbnb or maybe room by room. So at least, again, you're covering that mortgage while you hold on to this property for the long run. That's going to double and maybe even triple in value one. And my plan, and what I suggest to some of my clients that I work with, is that if you're trying to get financially independent by buying rental properties, buy more than you need today. Let's say you figure out if you had 5 properties and you own them with no debt, that they were paid off, and that would make you financially free with the rents those 5 properties bring in. I personally want to buy 10. I want to buy 10 that pay for themselves and let those go up in value. Then I'll eventually sell half of the portfolio and pay off the debt of the remaining 5. That way it gets you to that property amount you're looking for, the 5 properties that's owned outright. And now you have a great cash flow that's making you financially independent. In conclusion, I don't think you should only count on or consider cash flow when buying rental properties. You should also be thinking about increasing your net worth and your balance sheet by buying properties in high appreciation market. We just talked about appreciation today, but there are so many other benefits of owning high value properties in great areas, like depreciation. We've talked about depreciation in other videos, but the higher amount the value of the property, the more you can write off your taxes with depreciation every single year. And I do want a disclaimer out there that I'm talking about single family homes today. I do know people who've been very, very successful and built an incredible net worth by buying in markets that have high cash flow. I'm talking larger multifamily units and also hybrids of markets buying multifamily where they appreciate and have cash flow. Now that is a great deal, but today we're just talking about single family homes. I hope this video was helpful. And if you have any questions about investing in, buying, or moving to the Phoenix metro area, my contact info is in the description below. Reach out to me anytime, and I'd love to get back with you. And I make videos like this specifically about the Phoenix market on a weekly basis. If you want, like, comment, subscribe, and you'll see my videos weekly coming out every Saturday morning. And if you're thinking about moving to or investing in the Phoenix metro, but you're worried about our water situation, I've actually made a video about that topic, and you can find that video right here.